Hello students and welcome to the lecture. So students, as we know that we have started the financial system and basically what we are doing, we are covering the Indian banking system. Okay. This is the topic what we are discussing upon. And if I'm talking about the particular, you can say the area on which we are discussing right now. So basically these are the areas which we have in this particular series of the Indian banking systems. And we are right now discussing upon the generations of banking. Okay. In the starting, we have seen that there are basically four generation in the banking history of India. All right. The first generation, second generation, third generation, and the fourth generation, respectively. We have seen the, you can say, opening of the banks, while how the banks were opened. All right. Thereafter, we have seen the second phase, like what happened to them once they get open. And now, you can say it's a time for the third time. Okay, to see the third generation. So far, how many generations we have covered? We have covered the first generation, in which we had seen like how the Britishers and Europeans were establishing the banks and why the Indians started to participate in it. Thereafter, we had seen the second generation, in which we had seen the inclination towards the elite class. And now it's a time to look at the third generation. So let's start. So this is the third generation. All right. Remember, I have always told you to learn the timeline. Okay. The first generation do not having any specific timeline, but the second generation having the timeline which stands from 1947, the year in which we get independence, to 1967. Okay. Or you can also say 1969. Okay. Got it? It is two. 1947 to 1967 or 1969. Why? What is the reason behind this timeline? Because if we look at this particular picture, what is that year signifies? Just tell me what this year signifies. This year signifies the nationalization of banks, right? That's what we had discussed. Nationalizations of banks basically signified by the 1969. Okay, so let's start the discussion over it. First is the background. The period of third generation banking in India, spanning from 1967 to the 1991, was marked by the significant changes in the banking sector, largely driven by the government interventions and the policy measures. This period was characterized by efforts to make banking more inclusive and accessible to the larger section of population. Now, it's a time to create a picture. Okay, if we're talking about 1947 to the 1969, which means the second generation, what was the main issue we found in the second generation? What was the main issue? The main issue was inclination towards limited class of business houses or corporates. Okay, mostly banks which existed during this time period, they were inclined towards the limited class of the business houses and the corporates, and that's why the large section of population as well as working class was potentially excluded, right? That's the main reason we had seen that why the government started the intervention. Okay. Remember in the previous lectures also, I had told you that the banks generally had you can generally have the intention to provide the loans at the high interest rates, because the interest rate they receive on loan deduct the interest they give on the saving accounts, and the remaining one is their income, or you can say the profit. All right. So that's why the bank tried to provide the loan to those who could afford it on the higher rates, so that the profit could be maximized. Okay. But the time period basically we are talking about is the time period in which a large chunk of the population is below the poverty. Okay. Or you can say they were lower middle class, and even the middle class people are not so, you can say, wealthy and sound good in the terms of finance. Okay. That's why it was a, you can say, need of the time that we have to focus on the financial inclusion, right? About financial inclusion I had already told you in the previous lectures. All right. But here I'm just going to give you an overview so that you could remind it. Basically, the term financial inclusion signifies the inclusion of those who are generally avoided by the banks and finance corporation. Okay. The inclusion of those who are generally avoided by the banks and the financial corporations is the term of financial inclusion. These are generally the poor people who do not having a sufficient collateral. They could not bear the interest loans. Sorry, they could not bear the loans at the high interest rate. So that's why they are generally excluded or avoided by the banks and the finance corporation. So to include those also in the, you can say, banking circulation or the financial circulation is the term signified by the financial inclusion. Okay. And a large chunk of the population during that time was excluded because of being a part of the poor and, you can say, low income group. All right. That's why the government started intervention. It means that they were trying to take over the banks and their economy so that they could include the large chunk of the population. So the phase begins with the nationalization of the banks. Okay. So let's see it. One of the key measures taken during this period was the nationalization of 20 major private banks in two phases in 1969 and the 1980. Okay. Remember, as I had told you, basically it was started with the 1949 when the RBI was nationalized, right? In the year of 1949, RBI was nationalized. Okay. In the year of 1969, what happened? 14 major banks were nationalized. Okay. And in the year of 1980, 6 more major banks were nationalized, right? So just see the timeline: 1949, 1969, okay, and 1980. All right. So these banks which got nationalized, it means that they put under the direct supervision and the control of the government. These banks, when they were established as a private entity. Even the Reserve Bank of India, which was established by RBI Act 1934, okay, that was established as a private body. Okay, remember I had already told you when the RBI was handed over to the Indian government during the 1947, it was working as an you can say private institute or the private body. It was the year of 1949 when the Banking Regulation Act 1949 was passed so that the RBI was get nationalized. Okay. Thereafter, in the 1969, 14 major banks which were established as a private entity were nationalized, and 1980, 6 more banks were nationalized so that total number was 20 banks. Okay. So total 20 banks were get nationalized. Right? Two phases, 1969 phase 1, 1980 phase 2. This move was aimed at severing the link between the industry and the banks, reducing the influence of large business houses on the banking sector, and ensuring that the banks were more focused on serving the needs of the broader population. Now, this is what we had already discussed, but as I have told you in the starting of this lecture series, that we have to connect all the dots. Okay, so we had seen that the banks which got nationalized in two phases, these banks were basically, you can say, established and running by the private entities. And the private entities were richer of that time. And if the person is rich, its entire circle will be rich. Okay. So that's why there is a, you can say, inclination and the historical relationship between the, you can say, the banks and the lender. Sorry, the banks and the loan holder. So what happened? The banks were favoring them. Okay. Or you can say, for example, we had already taken the example in the previous lecture, but here I'm going to tell you again. If the XYZ is this, and there are 2%, okay, poor, business house, okay, if that's the condition, what will happen? The XYZ will go with the business owner or business house. Why? Because there are chances that might be this business house will have the close relationship with the owner of the XYZ. Okay, even if there is no relationship, they both are unknown to each other, but because of the profit maximization, the XYZ will favor that particular person. Got it? Got it? That's the reason. Okay. So to counter this particular thing, because as we are discussing, or you can say, as I have told you, during this time period, mostly population was poor, right? Mostly population was poor. So because of this particular reason, what was happening? A large section of the population was financially excluded. Okay. And only the small portion of the large business houses and the banking sector were getting benefited by the banking economy. Okay. So to counter all of these things, basically we had to nationalize the banks. Introduction of the priority sector lending. Another important reform introduced during this period was the concept of priority sector lending 1972. Priority sector lending mandated that a certain percentage of the bank credit will be directed towards the sectors such as the agriculture, the small scale industries, SSI in short, and other activities that were deemed crucial for the development of the economy and welfare of the population. Now, it is a term we require to understand. Okay, suppose this is the bank called XYZ. Okay, it's having the deposit of 100 crores. All right. In the previous lectures, also I had told you that the bank could not lend out the entire amount as a loan. Okay, which means if they had the deposit of 100 crores, they have to deduct the CRR, SLR, and then they could lend the amount. CRR, suppose it's a, you can say 4%, SLR is the 5%. Okay, so if you calculate the 4%, so this will be a 4 crore. So 100 minus 4, the remaining amount will be 96 crores. All right. And if we talk about the 96 of the 96 crores of the 5%, this is 30, this is 48. Okay. So it means that nearly about 4.8, or you can say at least round of figure is the 5 crore. 5 crore will be deducted. So the remaining amount will be 91 crores will be left with them. Okay. So this 91 crores is now available with the bank to grant as a loan. Right? But here comes the picture. Here comes the PSL, or we also called it as a priority sector lending. This is a picture, or you can say this is a term where entire pictures get changed. Okay, basically what happened, if we talk about this 91 crores, the bank will try to maximize the return, right? The bank will try to maximize the return. So what they will do, they will try to lend out this entire amount to those who could bear it on the high interest rate. Got it? But those who are needy, those who are poor, those who belong to those sectors in which their income is not, you can say, enough to bear the loans on the high interest rates, they will be financially excluded. Right? So to counter this side of situation, basically that was the year of 1972 when the PSL was launched. Okay, when the PSL was launched. So PSL is basically, you can say, is a certain percentage. Here you can say it is a certain percentage of a bank credit which will be directed towards sectors like the agriculture, the small scale industry, and the other activities that were deemed crucial for the development of the economy and the welfare of the population. It means that if the bank is left with the 91 crores, okay, so the government could direct the bank, or you can say on behalf of the government, the RBI, the Reserve Bank of India, will direct the bank to, let's suppose, reserve 4 crores as an amount which could be only lent out for the priority sector lending. Okay, 91 minus 4, the answer will be 87 crores. This is the amount the bank could use freely. Okay, so remember these calculations. If the bank having the 100 crores, they could not directly lend out it to the people. After deducting the CRR, the SLR, all right. Thereafter, after deducting the PSL targets, it means total rupees 13 crores will be deducted from the reserve amount, and the remaining amount could be used as a freely lent out by the banks. Okay, so this thing is basically done to ensure that those areas and those sectors which are crucial for the economy as well as for the welfare of the population, these areas must be benefited and must be credited by the banks. Okay, so remember this point also. Thereafter, transition from class banking to mass banking. The nationalization of banks and the introduction of priority sector lendings led to a transition from the class banking, which focused on serving the needs of the selected few, to mass banking, which aimed to cater to the banking needs of the masses. This shift was aimed at making banking services more accessible and inclusive. Like you can say, suppose if this is a private bank. This is the private bank. Okay, so it's having two areas. First is the capital. Second one is the deposits. Combining together, this is the available amount for loan grant. Got it? Capital plus deposit. All right. So that is the reason. Like the XYZ has to ensure the continuous interest on savings accounts, or you can say the deposit accounts. They have to give it. All right. And they will receive the interest on loans also. So what they will do, they will try to optimize this interest so that they could earn it better. This is the case of the private bank. Okay. But if we talk about the government bank, so the government bank basically having the leverage that they are being funded by the government. And how it is a leverage, how it's a benefit, let's understand it. Suppose on this, the XYZ is providing 4%. On this, they are receiving 6%. It means 2% is their profit. But what they will try to make it 8 or reduce it so that their profit could be increased. Okay. But when we talk about the public banks, or you can say the government banks, the government banks approach is not for the business. It is for the welfare approach. So what they will try to do, they will try to increase the interest on the deposit accounts so that more and more people could attract to the banks, and even they will charge the low amounts from the loan holders to promote the welfare approach. So if we go by this calculation, if it means instead of getting profit, there is a loss of 2%. Okay, but because they are being funded by the government of India, so the government will bear up this 2% loss. Which option is not available with the private banks because they do not having any backing from the government, okay, or from the any other player. They are on their own. That's the main reason why nationalization was necessary, because the private banks, which were established during that time, they were more inclined towards the class, or you can say towards the business class. Why? There is a clear-cut reason. Because you can say the business class is capable enough to get the loans on the high interest rate, and even there is a financial stable guarantee. Whereas if we talk about the mass, which were generally for the low income group people, these people do not having a sufficient, you can say, collateral holding, do not having the capacity to bear the amount on the high interest rates. That's why the mass were being excluded. Got it? But after the nationalization, as I have told you, when the government started funding these banks, basically they got the ability to bear out the losses they had faced during the time period. Okay, so this is the scenario how the class banking was converted to the mass banking. All right, I hope that you are able to connect the past with the present, and then we will connect it to the future. Okay, so let's understand. Sorry, let's move forward. Impact of the reforms. Like, what are the impacts? The reforms introduced during the third generation banking period had several positive impacts on the banking sector and the economy as a whole. And some of the key impacts include, let's see, widespread expansion of branch networks in rural areas, bringing banking services closer to the rural communities. Like, rural areas were of the low income groups, so the private banks were generally not interested to open the branches there. All right, but when the government took over the control, because the government had a welfare approach, they tried to expand their branches in the rural areas too, so that the maximum people could be benefited. Substantial mobilization of the public deposits as public gained confidence in the banking system and started using bank as a safe place to deposit their savings. Why? Because nowadays, or you can say on that those days also, the public had gotten confidence that the banks were basically backed by the government. It means that even if the banks had been suffering the losses, the government was backing them, the government was funding them. This confidence was not available when the banks were under the control of the private players. Okay, because if we go to the first generation, we had seen that many private players were got down. All right, that was the reason why the general public was not so confident in the private as they were in the public. Increase credit flow to agricultural and allied sectors, which help in modernizing the agricultural, improving rural livelihoods, and boosting agriculture productivity. Because as we had seen in the second generation also, the agricultural area was left out totally. Why? Because it was not of a good return to the private banks, as the industries and the service sectors were. But when the government took over the control, they focused on the agriculture as well. So that's why the modernization in the agricultural, improvement in the rural livelihoods, and other things could be ensured in a well manner. Okay. Conclusion, if we see, the period of the third generation banking in India was transformative phase for the banking sector, which was marked by the significant policy reforms aimed at making banking more inclusive and focused on serving the needs of the broader population, because instead of profit maximization, it was focusing on people participation. Got it? The nationalization of the banks, introduction of the private sector lending, and the transition from class banking to the mass banking were the key features of this period that has a lasting impact on the banking sector and the economy as a whole, as we had discussed, like how the financial inclusion was helpful to the large section of the population. Okay, similar with these things. Got it? So students, basically in this lecture, we had finished the third generation also. In the next lecture, we will continue with the fourth generation and the other topics as well. Till then, just revise all the facts and figures we had discussed in this lecture and be ready for the another lecture. With this note, let's end this lecture, and what we say thank you.